Buy term, invest the difference. You've heard about it before, right? It's supposed to be a great concept. And it is, if used properly, and if you're a robot. What we're going to talk about in today's wealth webinars, we're going to talk about theory versus reality. We're going to talk about buy term, invest the difference, the use cases, where it's a good fit, and why it doesn't work for most people that use it, but it can. And that is the big thing. It's not an investment problem that people have. It's a control problem. So we're going to show you how to take back control of your money. We're going to show you how you can be your own bank. And we're going to show you how buy term and invest the difference might work in conjunction with the specially designed whole life. Let's dive in. Welcome back, everybody. Another week, another wealth webinar. Today, we're going to talk about a topic that all of you have heard about, a concept that has been around for a while, and it is not the infinite banking concepts. We're going to be talking about buy term, invest the difference. We're going to talk a little bit about theory versus reality. We're going to talk about whether this concept is actually a fit for you, which I'm not saying there's anything wrong with buy term and invest the difference, but we're going to call out some of the facts, some of the statistics. And then we're going to show you why buy term and invest the difference as a standalone may not be the best solution for every single thing you want to do. And I want to talk about what happens in actual people's lives. So the real problem, which is what we're really kind of talking about here, the real problem is every single month, money comes into your life. You get paid, you exchange time for money. Okay, your hours are worth a specific dollar amount, and we just covered that on WTF today. How minimum wage is $7.25, but you can't live on $7.25. Heck, you can barely live on $25 an hour. So throughout all of your lives, you've had different metrics and different stepping on and stepping off places for how much your hour is worth. But nonetheless, you trade your time for money, and that money comes in. But yet every month, that money leaves. So the very first thing that signifies the problem is just our pure what we've been taught purely from day one about money. We've been taught to trade our most valuable resource for something that is not as valuable, okay? So we trade our time for money, and that's because we need money to exchange for the things we want in life, the things we need, the necessities. But the problem is we've been taught to make the money, pay everybody else first. We pay our expenses, our debts, we pay everybody else first, and what's left is what we call ours. And that's backwards. It's backwards by all accounts. It's backwards by the 7 laws of gold, the 6 rules or 6 laws of wealth. All of them say you must pay yourself first. So in the traditional way that we're taught, make money. Every month money comes in, and every month money leaves to pay the bills and everything else. And it goes a dozen different directions, right? All of you can kind of go through your bank statement. You can look at all your bill pays, all your checks you write. And then what's left, and if you ever have done a budget, is yours. That's the amount you can save, the amount you can buy term insurance with, the amount you can use for vacations and everything else. But again, I'm going to frame up that there's a major issue there, and that is just how we've been taught to deal with the money. You are the single most important person in this world, okay? You really are, because you're the golden goose. Your actions, your efforts, your productivity creates the money that allows these things to happen. So why would you put yourself last? The advice we've all heard, which would be the next one, okay? The next one is the advice we've all heard, and you've heard this formula before. It's simple. How many people actually follow through with these right here? So let's go through them. Buy cheap term insurance. I certainly own term insurance, 100%. I think it's essential. I think people need to have it. I think anybody that doesn't have insurance is doing their family a disservice, but buy cheap term insurance. So just based on the comments coming in, I think most of us have heard that, and most of us has followed that. Number 2, invest the difference. How many of you invest the difference? And now, how many of you followed what you've heard and what you've learned? Number 2, invest. Now, I'm not going to put invest in because I didn't follow this rule. How many of you plan to have that invested money sit there in that account, building and compounding for the next 30 years? And number 4, the last thing, the hope, and this is the plan, it's not even a hope, it's just you could say, I will be wealthy. Regardless of whether you'd followed 1 through 3, every bloody one of you better write, become wealthy, okay? Everything we just said sounds logical. Steps 1 through 4, it's 4 steps, simple. It's like Dave Ramsey's baby steps, right? buy cheap term insurance, invest the difference, stay invested for 30 years, become wealthy. You know, this is not just Dave Ramsey saying this. Primerica says this. And, you know, I want to be very clear before we even get kicked off here with this too deep. I want to let all of you know that, like, I am not against buy term and invest the difference. Not at all. None of us are. Matter of fact, Craig spent an nauseating amount of time over the course of a few months writing an industry accepted white paper on buy term and invest the difference. And there was nothing in that white paper that said buy term, invest the difference is wrong. There's nothing saying that it's bad. It was simply kind of calling out which is best for a particular person. And we ran all the mathematics behind that. So this is logical. But the real thing we're going to get into, this is where we're going to get into the theory versus the reality, is how many actual people stay plugged into this. So I know, and Elizabeth said Primerica too, rep for them. So I'm very familiar with Primerica. A super close friend of mine, Cam, has been an RVP with Primerica for the better part of a decade. He crushes, he does well. He's a super great human being. We butt heads every once in a while because of how Primerica has taught their agents. And you know, I suppose, Deborah, you probably, or maybe not Deborah, Elizabeth, you probably have heard this, that whole life insurance is the devil. It is bad. You can be duped if you're sold whole life insurance. And that's one of the things we're going to kind of talk about. So whole life is not bad. Whole life is not all the things that you've heard. It's just what Primerica and Dave have done so well is position their theory, buy term, invest the difference, as the only option people should choose. Because if you choose the other option, the whole life side, you're an idiot. I know I beat up on Dave Ramsey a lot on my YouTube videos. And if you haven't watched my YouTube videos, please go to my YouTube channel at the Chris Naugle. Subscribe to it first, but then just type in Dave Ramsey. You'll see all sorts of videos I've done. Some of them are absolutely hilarious. All of them are very factual and very real, eye-opening if you've bought into Dave Ramsey's philosophies that he is always right and everybody else is wrong. I think you're going to have an eye-opening experience. But let's get into this next one, theory versus reality. Let's just go through, and you can see them right on here. The theory of the situation, and this is what I call, if you're a robot, okay, you never panic during downturns. How many of you actually go through your investing, your investing journey, and you never ever panic? You bought into SpaceX at the high point and it dropped 30%. You didn't panic at all. You're just like, no big deal. You invested in a stock and the stock dropped 30%. You never panicked. How many of you have never panicked about your invested dollars? The other theory too that I missed over is, do you invest every single month? Every month you systematically have an investment program set up that money goes into. You never miss a contribution to your 401k. You never miss a contribution to your Roth. You never miss a contribution at all. You never lose your job. No one on here can say that. Now, maybe up to this point, you've never lost your job, but eventually everybody that has a job has the risk of losing a job. And that even means people that own businesses. I've had businesses fail, and my businesses, we could argue that those were my job, and I've lost them because I've either had to sell the business, I've had to close the business. So, I mean, never lose your job, okay? Never get divorced, okay? That's another one. Never buy boats, never go on vacations, never raid the account early. That's the big one, and I want to stop right there. Never raid the account early. In buy term, invest the difference, the theory is, for that period of time of the term, okay, so let's use a 30-year term, and just so you all know how term works, you're kind of renting insurance. It's much cheaper from a monthly or annual expenditure to buy term insurance because you're only buying protection for a period of time. You're effectively renting it for a period of time. There's no intrinsic value for the dollars you spend, but it kind of be like buying car insurance. I mean, I think all of you are the same with car insurance. You look for the cheapest insurance you can buy on your car, or at least most of us do. And if Geico has a cheaper price than Prudential, you'll go to Geico just like that. You'll flip, right? That's kind of like term insurance. It's more of a commoditized product where people shop term mostly because of a relationship, which is how Primerica has done really well. Like they've got this relationship model, which is a great culture. And then the second thing would be price. But Primerica rarely wins business on price because I can think of 15 other insurance carriers that are cheaper than Primerica's term. But it doesn't matter because the relationship trumps the price. And that actually makes all the sense in the world. But the second part is with term insurance is when that term ends 30 years from today, so 30 years, I'm 40, I'll be 49 this month, so 59, 69, 79. So let's just say I bought into that. today I bought a 30-year term policy. When that term policy ends at age 79, I basically don't have any life insurance anymore. It expires. And if I were to go out and try to buy a term policy at the age of 79, that's actually, sorry, I just had an epiphany. It's actually frightening to think that in 30 years from now, I'll be 79 freaking years old. Any of you ever had, did you have that moment, any of you? Like you took your age and multiplied it time, or you added 30 years to it, and you're like, whoa, yeah, 79. I don't think I'm getting insurance at 79. Maybe, but not term, because it would be way too expensive because term insurance is priced based on the age. Effectively, how term works is every year you get older, the cost of insurance is more. If you buy a 30-year term, what they've done is they've kind of levelized or annualized or averaged out the premium, okay, over the course of that 30 years, and that's what gives you your annual, which 30 costs more than 20, 20 costs more than 10. But the difference is you then put the money into an investment account. Now, if it was just a Roth IRA, you'd have to make sure that your Roth allows enough, per year to cover that difference. Okay, so that's step number one. And then if it's not, you just find a secondary account, like a Fidelity, a Vanguard, maybe an account with the gentleman over at PMC Wealth Advisors. This is the reality of what actually happens, okay? Because remember, we just talked about the theory, but here's what really happens, and all of you can agree with this or disagree with this. Life interrupts constantly. Things happen every day or every month that are unexpected, especially expenses. Car breaks down, main sewer line breaks, something happens like you need to have an exterminator come in. Life interrupts all the time. Fear drives selling at the bottom. Fear drives you. It's called investor sentiment. It's a very real thing. So outside of the couple that said, when the market goes down, you feel like you have to sell. Where's the bottom? I don't want to lose it all. Job changes, they break the habit. They break your investment routine, okay? Divorces, split the savings. So you might have been buying term and investing the difference. You built up this big nest egg. Something happens in your marriage. You get divorced. Your other half takes half, whatever. I mean, there's some arguments that could be made about that. How about kids, weddings, emergencies? Like, we don't always plan for weddings. We don't always plan for college or for all the different things and emergencies. So we dip into that pot of money that is supposed to be there so that someday when our term ends, we are self-insured, okay? That's what's supposed to happen. That was the theory. And then the difference, the buy term invest the difference, gets spent. All these things happen. This is reality. This is just life. And then early withdrawals and penalties. If you're investing in an IRA or even a Roth IRA, there are early withdrawal penalties in the first 5 years. So if you took money, you're going to get hit with a 10% early penalty, okay? Early withdrawal penalty. If you had money in a traditional IRA, and you took money out pre-59.5, there's penalties. So you got to see. So there's many things that get in the way from the theory that become our reality, and our reality shapes a totally different story than what we initially bought into. Let's go on to the next one. This one, I think, is the biggest flaw. The biggest flaw that nobody wants to talk about, okay? And that is that people rarely, and we have the statistics behind this, people rarely invest the difference. And that is the advice. That is the theory, right? You buy term and you invest the difference of what you would have paid for a whole life policy of the same death benefit. But the reality is most people spend the difference. Now, I know not this group. I mean, all of you are far advanced. That's why you're here. Let's go back into the biggest flaw that nobody talks about. And the biggest flaw, again, is the reality is that most people spend the difference because of all those different realities that I put in. It's not because you're irresponsible, by no means. It's not because you don't save money on a regular basis, by no means. It's because money that isn't automatically directed somewhere tends to find its way into everyday life. True or true? How many of you would agree with that statement? Money that you don't direct, money that you don't give a job to, somehow finds its way into everyday life expenditures. We spend it on going out to eat. We buy a pack of gum. We buy a Starbucks coffee every day. It just somehow has a way of just disappearing, right? So that would mean that behavior matters way more than a spreadsheet, and habits always beat projections. Now, to build a habit, there's different theories behind this, but effectively you could say it's 90 days to build a habit. A lot of people say it's 180 days. So for 180 days, if you wanted something to work, you'd have to build a habit. You'd have to start saving in that. And I always think the best way to save the difference or invest the difference is to do it into a place that's not as easy to take the money out. True? So invest the difference would not be take the money that you don't spend on the whole life because you bought the cheap term and put it into a high yield savings account. That would not be good because it's too accessible. And I'm not saying that accessibility is bad, but you just, until you build the habit, that might be a dangerous thing.
This says habits beat projections, and we've talked about when money doesn't have a job, and a lot of people agreed, this money just finds its way into going out to eat more often or expenses, whatever it's going to be. And I think part of this really comes down to building those habits. And I'm just curious with the all the people in the audience, do you know where those dollars are going? Are you giving those jobs dollars? And what I'm really asking is, are you tracking where those dollars are going? And then what that excess is, and are you giving it a job to do? So I think that's just something for everyone to think about is if you're not tracking those dollars today, you should be tracking them. There's a lot of tools out there, Rocket Money, Quicken, Monarch, whatever it's going to be, but track those dollars. It's going to shine a light on where those leaks are, and then you can give the take the next step of giving them a job to do. So I just wanted to kind of highlight those pieces too.
Well, let's go on to the next part because this is the part that I think is really important to talk about. What happens when the term ends on the life insurance? Now, this is planned through in the theory, right, of buy term invest difference, because effectively just using a 30-year term, okay, over the course of the 30 years, you had the insurance company taking all the risk. So if something should happen to you and you should graduate too early, graduate meaning go on to heaven, too early prior to the 30 years, the insurance company was 100% on the hook and at risk where they'd have to pay out the death benefit. So let's just call it right here, let's call it $1 million death benefit, okay? And you buy a 30-year term insurance policy because you're in your 30s, it's relatively inexpensive. Your premium per year, I'm just making this up, is $390 a year, okay? Might be more per million, but we'll just keep it whatever it is. Then at the end of 30 years, you should have, okay, in theory, saved up enough or invested enough in that side fund, that Roth, that brokerage account, whatever you used, in 30 years with compounding, with investment gains, you should have more than $1 million. Now, we could all argue that yes, you will, no, you won't, maybe you will, maybe you won't. A lot of factors into there, but it could very easily be planned. I mean, PMC Wealth Advisors, they could figure that out. We could figure it out at the advanced markets team. Anyone on our team could probably reverse engineer that with a present value calculator to figure out how much money you'd have to invest at a specific rate of return to get that desired outcome of $1 million. And again, you'd probably have to be a robot because you wouldn't have had a divorce during that 30 years. You wouldn't have had unexpected things that made you dip into it. Nothing would have gotten in the way, not investor sentiment, nothing that would have had you dip into that money. So now you got $1 million. The term insurance in the 30 years ends. You no longer have insurance. All that risk that the insurance company had, they no longer have it. It all shifts to you, but you've got $1 million. So you are technically self-insured. But are you? The death benefit at $1 million would have paid you $1 million tax-free. I should say, would have paid your beneficiary $1 million tax-free. Your invested dollars, depending on what they're invested in and how, what the structure was, you're going to have different things that had to be factored in there. Number one, there's fees in most investment accounts. Even if you go out and buy an ETF, okay, and you do it yourself through a Schwab or Fidelity platform, there's still a management and 12B1 fee on that. So you got to factor that out, the fees. But the other thing is if it's not a Roth, okay, that money is taxed. So you'd have to pay tax. And every year, if it was a brokerage account, you would have been nipped the taxes on the gains that you made in that account. So all these things have to be accounted for, okay? And also, you must not have accessed any of that money because that money is to protect your family after the term insurance ends. That's how it's supposed to work. So in theory, that would mean it's affordable, it's simple, and it's smart. And I guess if you really thought about it that way, well, that makes sense. I'm self-insured. I no longer have to pay for life insurance because I got $1 million. That $1 million would go to my family. Should something happen, that'd be enough to pay off the house. The cover, sorry, I cannot get rid of this cough. Annoying. But you can't buy term insurance anymore if it's 30 years from now for most of you. Maybe if you're 30 and you're 60, then yeah, but your cost would go probably to over $10,000 a year. So it's cost prohibitive, okay? But the other thing that happens is not all of us stay insurable. Things happen, like I got this wicked cough. Who knows? Maybe it's something more than just a cough, right? Maybe I become uninsurable in 3 months from now, and I can't ever buy life insurance the rest of my life because this cough happened to be emphysema, which happened to turn into, I don't know, I'm just making it up. I don't want to even put that into the universe, but you get the point. We just don't know what's going to happen. You could get in a car accident, could get rear-ended, and then all of a sudden, boom, something you didn't even do, you're uninsurable. But the stories beat statistics, okay? Stories beat statistics. That's what happens here. And the other thing I want to talk about is I want to talk about markets. I want to talk about how the markets actually move. Because if any of you think the markets move in a straight line up, they do not. Even over a period of 30 years, that is not the case. This is what the markets look like. Okay, there's sequence of return risk. Okay, that's a huge one. A bad year in retirement could damage your entire retirement outcome, period. That one bad year could put at risk your entire retirement. And that's because of sequence of returns. Volatility. Volatility is about as real gets. We've had a very volatile market. Yesterday it's up. Today it's down. The next day it'll be up or down. We don't know. It's volatility. Every dip will test your discipline. Every dip in the market will test your investor sentiment. There's only a couple on here who never look at it and they just know it's going to be up in the long run, and they are right. Over a 30-year period, Craig has run the numbers. It'd be very unlikely for us to say that in 30 years from now, you will not have made money investing in the markets, period. The problem is not how much money you'll have in 30 years. The problem is not touching it for the 30 years, not allowing your emotions to get involved, not having any unforeseens that make you dip into it. And listen, we have thousands of clients, over 7,000 clients combined. And I will tell you that there's not one of those 7,000 that hasn't had an unforeseen event happen. That's why when we design and engineer our specially designed whole life policies, we build the desired premium deposit and we give them a minimum because we know for a fact things are going to happen. They might start at $10,000, but then next year something might happen, a divorce, unforeseen, they lose their job. Now they can only do $3,000 a year. Whatever, we build those thresholds, but the volatility is a very real thing, and uncertainty is just built in. Uncertainty is 100% built in. Nobody knows where we're going to be in a decade from now. We don't know if we're going to overperform, underperform. You just never can tell. So these are things that you really need to consider when looking at buy term invest the difference. Now, again, not that it's a bad concept. It's just a concept that requires a little more planning than just like this is the best. This is the only way you should do it. You're a fool if you look at other ways, because we're going to get into the numbers at the end of this, and I'm going to show you that the other side, the whole life side, even if you just did a regular whole life, almost in every scenario, you would have been better off doing the whole life than you would have been buying term invested in difference. But I still will argue, till the day I'm dead, everybody should have term insurance to cover those risks that have a term of time. And the other thing that I think everybody should get out of their mind, the Dave Ramsey theory, I don't think there's one person on here out of the 100 people that will be living in the same house they're in today the day they die. Statistically, maybe 1% or less of you, because we buy a new house, we upgrade, we downgrade, we change locations, our kids move away and we want to move to be closer to them. Listen, it's it's just not even comprehensible to believe that somebody's going to live in a house for 30 years. And Dave Ramsey says, pay your house off, be completely debt-free, buy term, invest the difference, and it'll be easy because your expenses will be a lot lower when you get to that 30-year period or that retirement period. Folks, they taught me this in the Wall Street world. When I was an advisor, I'll never forget it. Over and over and over again, our consultants and our trainers would teach us, your clients will make less in retirement than they do now. So they'll be in a lower tax bracket, they'll have lower expenses, because they're going to make less. How many of you, in all fairness, how many of you want to make less in retirement than you are now? Because that to me says failure, and I don't even know why you'd be on this webinar. That is the pure definition of failure.
Can we spend just a few more minutes? I see we have sequence of returns risk. I'm sure a lot of people understand that, but for those that don't, can you just kind of talk about what that is, why it is something we should be paying attention to, and how that can change things for us long term?
Go to year 6 over there, okay? Just look at number 6, look up. Year 5, you were crushing it, okay? Year 5, your return was about 30%, just under 30%. By all accounts, that'd be a complete win, right? And over that period of time, let's just say you've averaged 10% with the ups and downs. So you've averaged 10, and that year, whoops.
Oops, hold on. Okay, sorry about that.
That year, you got a little click happy. That year, you made just under 30%. You're crushing it. And this just so happens to be the year you retired, or it doesn't even matter if it's the year you retired or not. The next year, year number 6, the market takes about a 12% drop, just 12%, no big deal, drops 12%. But you need money from your investment account, which means you have to sell the stocks, mutual funds, or ETFs or bonds that you're in. So you have to sell them because an emergency happened or you just need money to live on. So you do that, no big deal. You've done so well. You've averaged 10%. You hit last year, you did 30, and now you're down 12. By hitting that 12% mark, and I don't have the exact drawdown number for that, but if you lost 12 and you took the money out, that means you took the money out at a 12% drawdown. Okay, your stock was worth 12% less, which means now just to get back to where you were, you have less money, 12% less money compounding and earning to get back to where you were. So you don't have to make 12% to get back even. You have to make more like probably 20% to get back to normal. Okay. So then the next year, market goes up, everything's on pace. But then the year after that, year number 8, minor down year, like 9% down. And you're taking an income, no big deal. But the next year is a 20% drop in the market. Okay. And you're still drawing money because you're retired, you're taking money out, and you take money out now during that whole downward span, which has been 2 years. I will tell you right now, you just killed your future plans. Even though the next year is a huge year up, you just destroyed it because now by taking money out at 20%, you don't have to make 20% to get back to normal. What is the number on the drawdown at 20%, Stephen? Is it 25%? So 10% would you have to make 11, 25 you have to make, or 20 you have to make 25. So an additional 5% more. At a 30% loss, you have to make 43% more. At a 40% loss, 67% more. This is just to get back to level. So do you see where the drawdown effects in the sequence of returns really matters when you're taking money out? Now, for some of you that would say, we're never going to take money out, that's unrealistic, first off, because why would you save up a bunch of money just to make sure that when you die, your family has it? Like most people want to enjoy life and make memories. So the whole idea behind insurance is put all the risk on the insurance company. Spend your money, enjoy your life, make memories. But if we're doing the buy term invest the difference, the invest the difference has to self-insure eventually. You have to determine what that self-insurance amount is. You have to factor in inflation. You have to factor in lots of different things, taxes, fees. So you're effectively saying that the money that I'm building up in this invest the difference account is going to just sit there.
What Chris is talking about with those downturns, it's rare that a market's going to go from, say a 20% down to -20 and then pop back up the next year. So in the Great Depression, when we had the market crash, how many years do you think it took for us to recover? So basically just, that big drop down happened. How many years before the market was back to where if you have $1 in there, you lost some money, how long would it take you to get that dollar back? So really the question is, how many years did it take to recover? Thomas comes in with 20, we got a 30, 25, a 10. I was actually expecting everyone to answer, with something less, but it was about 25 years. That's pretty wild. 25 years to recover. So anyway, just wanted to throw that out there. So we have to think about these downturns, and if we're in the retirement distribution stage of our life, those are really impactful. And what if it took 5 years? What if it took 7 years? I think the 2008, 2009 was about a 5-year recovery. So anyway, we have to consider that and all the things we're talking about.
That is very important. But you know what? Let me hit on one other thing too, and this is a little sidebar. Okay, you know what smart people do, what sophisticated investors do, what people with good financial advisors do, is when they move from an accumulation phase, which is very relevant. Because remember, we're going to talk about financial advice focuses on accumulation, almost all of it. But when you move from accumulation to distribution, which is when you go from I'm accumulating wealth to now I need to live off that wealth and take an income. There are much more efficient ways to do it than the stock market. Matter of fact, the stock market is very, very efficient at accumulating money, always has been. But it is probably one of the least efficient vehicles for distribution of money. So if any of you are approaching retirement, the one thing I would urge you, I would warn you, I would basically argue with you about this. As you get close to planning for your retirement, or if you're already in retirement and you have not done this, please, 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 please guarantee your income for your basic expenses. This is a very easy thing to do. And insurance companies have products, SPLIs. There's all sorts. Oh my God, now I'm forgetting the names of them. Single premium SPAs. There's different
Single premium immediate
single
annuity.
premium immediate annuities, SPIAs. That's what I was looking for. That you can put a chunk of money in. So you can shift money from the Wall Street markets into these SPIAs, these fixed income annuities, which are guaranteed. And those income annuities will guarantee you an income for the rest of your life. Now, here's the other advice I'd give all of you. And this is very good advice. Don't wait till the day you retire to do this. Let's say you want to retire in 5 years. Start now. Shift a portion of your accumulated 401k or IRA assets into a deferred income annuity or a deferred indexed annuity. Okay. And then wait that 5 years, allow it to accumulate, and it can be accumulating with an index. Okay. You can tie it to an index, a bond index, which is what I'd recommend. And then when you get to retirement, then the income flips on, but you haven't missed that 5 years of guaranteed growth because it was guaranteed to grow during those periods. At what rate, it depends on the index. But then once it hits retirement, your income stream will not just be an interest rate, right? So if in the market, your income would be based on your return. And if you look at statistics, the distribution phase should be a 4% withdrawal rate. I don't know many people that can live on 4% of their invested assets. I'm sorry, I just don't. There's very few people that can, because $1 million would give you $40,000 at 4%. That enough for any of you? No, right? So you're not going to be able to live on 4% withdrawal rate unless you're independently wealthy. But if we did this strategy with the SPIA or with the deferred income annuity, indexed annuity, what you would then do is you would guarantee yourself an income that isn't just based on an interest rate, but it's based on accumulation credits or actuarial credits. They call them mortality credits. So your age factors into this because the insurance company is saying, we know when you're going to die. So we're going to take this chunk of money you gave us. We're going to turn it into an income. We're going to give you a guaranteed interest rate on that money. So your payout rate might be 8 to Craig or Brian. What's the highest payout rate you've seen on these?
I think 12%, 11%.
Can you imagine getting an 11 or 12% guaranteed income? I think a lot of you could live on that, right? Because if that was $1 million, that would mean you'd get roughly, well, what would that be? $110,000 guaranteed. And you're not going to shift all of your assets into this. You're going to shift a portion that covers your basic expenses. So there are ways to do this. And folks, just real quick, just because I'd be remiss not to do this, if any of you want to learn more about this, this is one of the most opportune times to look at this kind of planning because where rates are. Rates are at an elevated level. They won't remain here. Wouldn't even comment on it today. So that means like the future isn't so predictive as Bank of America wants to say, where they're going to raise interest rates. We don't know if they're going to raise or lower them, but if they lower them, that number would change. So right now, it's really an advantageous time to get on the phone with Brian or Tess. Both of them are on here. They're our annuity specialists. They can run some numbers. They can put together a plan for you and show you what your guaranteed income would look like. You can call 866-329-BYOB. We'll text it in there. But what you do is you de-risk your entire portfolio. Now, all of a sudden, all that invested difference money, that retirement money, it doesn't have to be at risk. You've guaranteed the portion that matters, which is your fixed expenditures. So hopefully that helps some of you. But let's dive back in. I deviated from that. Let's talk a little bit more about financial advice on how it just focuses on accumulation, because that's all advisors really focus on. It's an easy sell. Okay, that's every advisor's pitch. But the question I would ask is, or the question you should be asking is not how much can I accumulate? The question is, can you access your accumulated money as it builds? Do you have access to it? Okay, the second question I'd be asking, do you have access to it without penalties? Okay, without penalties. The next question I would be asking is, can I use the money and not have to pay taxes on it? Because there's silent killers to your wealth. Inflation, taxes, fees, okay? Those are silent killers. And the most important thing to ask yourself about your accumulation money is, can I use this money if an opportunity presents itself? Can I use this money to start a business? Can I use this money to buy a property or a rental property? Can I use this money for a need without asking anyone's permission? Well, can you? I think that's a really important thing. Craig, do you have anything you want to say, or Brian, anything you want to say on that topic?
I think last week we talked about the four stages that, the especially designed whole life policy would provide, which is, you do have some accumulations, you're putting your savings in there, But we have to think about all the other things you can do. So as we're accumulating, we have access. So we can take loans without hurting that that building up of those funds. And a lot of people look and go, well, why are you so excited about whole life policies? It's just all of the things that come with it. It's the tax advantages, the safety around the predators and creditors, and every state's a little different there. But the uninterrupted compounding while we're accumulating and accessing that money, so we can go pay down debts, we can fund major purchases. So we talked about, you've got kids and weddings and emergencies, and a lot of times I look at those things are all linked. Whenever you have kids, there's most likely going to be emergencies and there's most likely going to be weddings. So if it all points back to the kids being those costly things there. But we're accumulating, we have access, and then if we think about those distribution phases where you have a traditional retirement account, when you're doing a distribution from there, you do have taxes. You have IRMA, which is going to impact your Medicare, and maybe even cause your Social Security to be taxed. So are there more beneficial ways or more efficient things to do during those distribution phases? And then, of course, there's a legacy. I always tell this bit of a dad joke, but out of 1,000 people born, 1,000 people are going to die. So we will have a legacy to pass on. And what if that was a tax-free legacy that's being passed on? So as we think about the shift in these tools, what tools are out there that give us the ability to accumulate, access, distribute, and also provide a legacy? And maybe you mix some tools together to achieve everything you want to do, but I think that's really what we're talking about with control. So I just want to throw that out there, Chris. And then Brian, I don't know if you have anything you want to add.
Yeah, I mean, one of the things that I've been coming across, and this is more of it's not really mindset, but it's a knowledge thing. And when I'm talking to people about retirement, their portfolio, a lot of them will say, "Well, I've got a balanced or a diversified portfolio, or my investment advisor has me in a diversified portfolio." And I'm like, "Okay, what are you in? Stocks, bonds, treasuries, REITs, precious metals sometimes even." And I'm like, "Well, that's all in the risk bucket." And people don't realize that that's all in the risk. You don't have any guarantees inside there. You can actually lose a lot of value inside there. And once you start taking income from that portfolio that is balanced, it starts going down in value. And a lot of people don't realize that a true balanced portfolio is also going to have some of that guaranteed income. And very few people have that anymore because it's gone away, to be honest. Like the pensions are not popular anymore because the employers do not want to provide the pension because it is risk for the employer. So that's why 401ks are popular now because the risk is on the employee, but that's also the risk bucket. And so what Chris was talking earlier on is starting to remove the risk from your portfolio, your retirement portfolio, getting more guaranteed income so that you're removing risk. Because, I mean, to be honest, one of the biggest fears of retirement that I've been hearing about is not having enough income to survive. That's very scary. And so I'm having a conversation, had one this morning. A family is doing the exact same thing that they've been told to do. They have all their money in the risk bucket and did not realize that, hey, we should have been filling up the guaranteed bucket. And so now we're having those conversations, but I'll be honest, I mean, they're kind of late to the game a little bit. And so as Chris said, don't wait till retirement, start getting ready for this ahead of time, especially in the current rates we have right now, where you can start guaranteeing that income 5 years down the road, 10 years down the road, but you can turn that income on at any point. To be honest, you can turn it on if you need to earlier on, but it starts to get rid of that risk. And so if any of you are in that kind of situation where you have a lot of risk in your portfolio for retirement, yeah, just have that conversation. Reach out to myself or Tess, or just put in your number into the Q&A or comment box, and then we'll have that conversation. Because if you have any concerns about it, have the conversation now. Don't wait.
Yeah, Brian, I think what you said is really, really important because, the path a lot of people take is you start working at a young age. Maybe the company you work for has a 401k. It's just a good feeling to think, oh, I'm saving for my future, set it, forget it. And then when you get to retirement and you look at it and go, well, I don't know if this is going to, get me to what I need to, accomplish with living. And so I think we all need to evaluate our own situation. And I call it my fortress or my guaranteed income. And the way I approach it is will I have enough if everything else goes away? Let's just take all the investments, all the assets out of the way. Will that guaranteed bucket give me a roof over my head, a couch to sit on to watch TV with some food? And if I can solve that, you know, that's my guaranteed bucket. The rest
Yep.
of it, I feel a little better about going and doing investments and building other assets because I think Deborah was saying you should only invest what you're willing to lose. I'm not willing to lose anything, but I get the idea is we shouldn't be investing our grocery money. We shouldn't be investing the money we need for, the basics of life. And that's where this guaranteed bucket falls in. I think it's just not thought of because it's not fun and exciting. We're sitting around at dinner parties, hey, I've got these annuities that are going to, or these whole life policies. It's just not the exciting thing. We talk about, the stocks we got into at Apple and then it went up, 3, 10, 20 times. But I think everyone needs to take a pause and think about that guaranteed bucket that they have and build
Yeah,
that.
and one thing I'll mention about that one that I know Chris mentioned the 4%. I've actually heard that they're actually recommending like 2 or 3%, not even the 4% anymore because it's not enough. And if you do the math on this, this is something that blew one of my clients away. 4% on a $500,000 401k is $20,000 per year. That is nothing. That means you've got to have multiple seven figures to have just your basic expenses covered at 4%. What if it's 2% or 3%? What if the market drops? What if an annuity can take the same dollar amount and provide you 8 or 9% guaranteed?
Yeah, Brian, I think Wade
Yeah.
Pfau is talking about 2.8, or he referenced 2.8 as the new 4%.
Yeah.
So it's pretty crazy.
So I mean, it's almost kind of mind blowing that you would actually even consider keeping a 401k at that rate when you can do an annuity that's going to guarantee it at 3 to 4 times that number. So just something to think about.
The other thing I want to hit on here is I want to hit on how we were always so obsessed with the return, the rate of return. It's like a hot thing, well, what's the return? We hear this all the time with whole life insurance. People are always like, oh, whole life insurance, it doesn't, what are you going to get? 5.5% internal rate of return? I can do way better in the market. But that's the thing. They just don't understand that what we talk about is the and asset. Because if you put money into a whole life, it is not an investment. That whole life policy then can be used. You can leverage your cash value, use the money to then invest. So you can make money twice on the same dollar. So when people come to us and they're like, oh, whole life never would beat the stock market. Whole life wouldn't beat crypto. Whole life would never beat real estate. We understand that. And that's not the point. Whole life has one job: to protect you and your family, to provide tax advantage, well, more than one job, but to provide tax advantages, and also to give you a liquid fundamental bucket of money, the cash value, that can be used for everything else in your life without asking questions, without penalties, without taxes, because if it's built right, it's in a tax-free account. So again, it's not about the return on investment you're getting or the rate of return. The better question is how much control do I have over my money? That's the question you need to be asking yourself. This is what advisors don't teach you because they're taking control of your money. You need to be asking the most important question: how much control do I have of my own money? In the event of a need, because you got to define control. What does that mean? It means you can access it without penalties. It means you can access it without taxes. It means you can access it for any opportunity, anytime you want. That's the thing. That's what makes whole life the and asset, because it gives you all those. It gives you liquidity of your money. It gives you control with no market gatekeepers, nothing. It gives you predictability. You know exactly how much money you're going to have. It's an opportunity fund that can be deployed for big expenses, big moments, businesses, colleges, weddings. You can use it to finance anything in your life, like a car. I do it all the time. I take loans from my policy, and I'm going to be doing it again here in July. And I buy a car, and then I make payments back to my policy for the exact amount I would have paid, whatever, GM Financial or Porsche Financial, whatever they're called. But the other thing that we talk about when we talk about term insurance is a legacy in this damn cough. The wealth that hands down to your next generation, your kids, your family, to maintain their lifestyle. That's the single most important thing. And that is the number one thing that fails in buy term invest the difference. People will do their best to invest the difference, but the term is guaranteed to end, not guaranteed to pay. Less than 2%. of every term policy ever written. ChatGPT it, Gemini it, Grok it, whatever. Check anything you want. Less than 2% is the number. That's how many term policies pay out, less than 2%. So you think that's a really good thing for the insurance company? It's funny, we were out in Indianapolis talking to one of the big mutually owned insurance companies, and we were just joking around. We were talking about our buy term invest a difference division, and we were just joking about like term insurance. They say, you guys like term insurance, right? That's a pretty profitable product. And on the other side of the table were all the insurance executives, and they were just giggling and laughing. I'm like, yeah, it's kind of a cash cow for you, isn't it? Giggling and laughing. Of course, it's the #1 profitable product because they never have to pay out on it. You would all love to own a company that you never had to fulfill on the product that you sold. You literally sold it, you got all the money, and it cost you nothing to deliver it. Like, that doesn't exist anywhere else. Like, car manufacturers manufacture a car. They got costs and expenses to manufacture that car and to service that car. And then, they make a profit on it, but they make a profit one time. Like, insurance companies, they make a profit 98+% of the time on term insurance. So, like, it just all makes sense. But whole life insurance, #1, I hate it when people say, oh, invest in whole life. You don't invest in whole life. It's a guaranteed product. It's not an investment. But the other thing here is, it's the and asset. It's not designed to beat the returns you get in the stock market. It's designed to give you an additional tailwind behind your money, an additional uninterrupted compounding interest behind the money that you then invest in the market, that you then invest in real estate, crypto, or anything else, your business. That's the point. You take back the banking functions in your life, and this is just the fundamental place where you store your wealth. That's it. That is all there is to it. And for that, you get a guaranteed death benefit for the rest of your life. Now, you're still going to have term insurance. I'll give you an example. I have a $1 million term insurance policy that I took out many years ago. I think there's like 11 years left on it, okay? That policy was taken out because back then I had a mortgage on my house, which I still do now, but this was back then, that I wanted to make sure was protected. So I wanted to make sure that the mortgage and a couple other lines of credit that I had, if I died prematurely, those would be paid off. And I figured, okay, in 20 years, I won't have these anymore. My house will be paid off because I'll get it paid off, or I'll be on to a new house or whatever. So that term insurance served a really good purpose. But at the same time I had term, I also had whole life insurance. I've shown you the numbers and we'll look at them in a second, but I always had whole life insurance because I knew someday the term was going to end and I didn't want to leave my family high and dry. Plus, I knew that over a course of time, that whole life would pay me back in cash value all the money that I paid in premium. And then I would just be making a tailwind of returns on that money for the rest of my life. And how much did the life insurance and the whole life cost me at that point? Nothing, says R. Nelson Nash, because I've got all the money back for every dollar of premium I paid. And there isn't a day that goes beyond that day that I don't make money for the rest of my life while my family maintains protected, while I keep privacy of how much money I have in there, while I get to gain tax-free growth, internal cash value growth, and at the same token, it's protected against judgments and liens. So if someone slips and falls on one of my properties, sues me, they can't take the money in the whole life in most states. That isn't the case in your invest the difference account. That shit's low-hanging fruit. Unless you put it into a Roth, then there's a little more protection. Okay, but I'm just trying to call out the obvious. It's not this or that. It's this and that. Okay, it's the and asset. And when I say the and asset, I don't just mean the whole life and the investments. I mean the whole life and term insurance and the investments and the real estate and the crypto and the business. This and that and that and that. And that's going to be a new t-shirt. I'm going to make a new 4th of July shirt, 250 years, that says this and that 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 and then this too. Anyway, let's keep going. How money actually flows? Let's talk a little bit about the flow of money. Okay, this is it. You make money, your income comes in. You fund your policy, okay, with the amount that you normally would save. You change one thing, and that is the amount you would save in a bank account. That's all we're doing, just displacing money that you normally would leave in a bank, because we don't want banks hanging on to our money. If you have money in banks above and beyond what you feel is a comfortable emergency fund, okay, if you have anything above and beyond there, just remember, you're giving the bank control of your money. The bank is taking your money and lending your money out without asking your permission. They're making 400 to 1,300% on your money that you worked for. I shouldn't need to say anything else. Let's take that away from the banks and let's put that back into your control. So that's the policy. Once you have the policy, immediately in the first 30 days with the specially designed policies that we do, which reduces our commission by 60 to 90% and gives you 60 to 90% more access to your cash value immediately in the first 30 days. We don't say that enough. You take money from your policy. And you can use it to purchase a car. You can use it to buy out your current car loan. You can use it to buy out your lease. You can use it to buy a property. You can use it for a new business that you want to start, like Stevie Bell, ex-pro snowboarder. He's one of our clients. Took a loan from his policy to start his podcast. His podcast is exploding. The loan from his policy just remodeled the studio and gave him that money to hire a videographer and chase his dream of doing a snowboard-specific podcast, which is awesome. I'm like, come on, think about that. What are your dreams and aspirations? Be the bank. That's what he did. Okay, then what he does is as he makes money on his podcast, because he monetizes it, I'm one of the sponsors, he then takes the money I pay him minus the expenses and he rolls it back over to his policy as a loan repayment. And you just rinse and repeat this as many times as you can. Paying off debt, buying cars, anything. That's the process. You see, the money never leaves your ecosystem. Here's the thing. If you did this exact same thing from a bank account, replace policy with bank account, okay? All this would work. You could take the bank account, you could take the money, so it wouldn't be borrow, it would just be withdrawal. You could purchase the car, start the business, do the opportunity. Then you could repay yourself and refill that bank account. But here's the difference. In this system, with the whole life policy, your money never left your ecosystem. Your money never stopped earning uninterrupted compounding interest. The insurance company paid you guaranteed interest plus dividends every single year on your policy. And that money never left your policy. When you borrowed, you took the insurance company's money. They lent you money from their general account. They subtracted it from your death benefit, and they'll never ask you for it back because they know you're going to die. And when you die, they're just going to make themselves whole. And in the meantime, they charged interest on that money. And this is the part that a lot of people, especially, the buy term invest the difference people, with the exception of the guys that I've talked to that understand this, they're like, that's stupid. Why would I put money somewhere where I got to pay interest to use it? Well, if you understood banking, you would understand that because a bank does the exact same thing in reverse order. When you put money into the bank pays you interest, right? What are you getting? 2, 3? Anyone getting more than 3% right now? And I want to come back to the question, how do you figure, Chris? I will come back to that. But let's just finish this discussion. The bank pays you interest. How much are you getting at your bank? Put it in the chat, okay? 2%. Now, the bank then takes your money that they're paying you 2%. They're on the hook to pay for that money, and they lend that money out at 6. So what did the bank make? 6 minus 2. They made the spread. Now let's flip it over to here. How do I figure, or how would this work? You take a loan from your policy. The insurance company, let's use One America, charges you 5%. It's actually 10 basis points less or so, but we'll use 5, okay? But the insurance company, let's just pay you 5.5%. What did you make? You made the difference, net, because the 5.5% I gave you was the net internal rate of return. So if that's 5.5%, but the insurance company is charging you 5, what did you make? You made 0.5%. Now that doesn't get you excited, but you're making 0.5% on top of whatever you're making on the next place the money went. You're making money twice on every dollar. And then if you just repay it, or what we call recycle and recapture the money back to the policy, you're paying the loan down, which is immediately giving you more liquidity, dollar for dollar, not 90 cents on the dollar, not 80 cents, $1 for $1. You put $1 back in your policy as a recaptured loan repayment, you have $1 to use the next day, okay? But that $1 that you put in, that you had full liquidity of, reduced the loan you had to the insurance company. So now the insurance company is charging you interest on a declining balance. Simple interest versus compound interest. There's a huge difference. So every year in this money flow, every year you're guaranteed to get a raise. Every year you're going to make more money than you did the year before. Every year your spread's going to go up. No ifs, no ands, or no buts about it. It is just math. And it does not take any additional work other than following the flow and setting the system up. And that's actually one of the things that I like to mention about the wealthy. One of the things we're going to get to here when we talk about the wealthy families is wealthy families don't do things too much differently than you, but they do them with systems. So I'll wait to kind of get to that, but that's how your money flows, folks. And the real implementation part is the next part, which is really got to be concrete in your mind. One of the things that we'll cover with wealthy families is wealthy families put their money to work. They give their money directions. They make their money go out there and work for them. And that's what we're talking about here with this implementation. So let's just talk about a car purchase. So we all know there's 4 ways to buy a car. You can pay cash for a car, which is just like financing it, because when you pay cash, the money you paid for the car is money that can never work for you. So you gave up the opportunity for that money to earn interest. I want to be clear that buying a car cash, in most cases, is one of the probably dumbest ways you can buy a car, paying cash for it, because you bought a depreciating asset with the most valuable dollars you'll ever have. Those dollars can never work for you again. They're just gone. and you lost opportunities because of it. You can also finance a car. And then, if you finance it, you just make principal and interest payments back to the finance company. So you lose whatever the interest is plus the depreciation on the car. You can lease a car. A lot of people lease because the payment's lower, but it is actually the worst way because the factor that they use to figure out your lease payment has an interest rate built in. And last time I checked, it was like 7 or 8%. So you're giving away 7 to 8%. Actually, you're giving away 100% of your payment because you get nothing in at the end. You just turn the car in and you start over, and your car lease almost always goes up. At least that's my experience. And you can steal a car, but you could go to jail if you do that. But there's another way to buy a car is you could buy a car with your own banking system. So every dollar I pay back to the loan is a dollar I have to use. And the answer is yes, but not just that. You get a dollar for dollar, okay, use of that money, but you also make the interest spread go up. When you make a car payment, okay, you don't get a spread. The bank makes the spread. When you are the bank, you're making a spread on your money, and that spread is guaranteed to go up for whatever the term of time is you're buying the car. How about a business opportunity? Okay, I do this all the time. We recently just did this. PMC Wealth. Okay, we started a registered investment advisory that Brandon and Stefan run. How did I finance that? I took a loan from my private banking system. Do you all know what my private banking system is? It's a bunch of whole life policies, believe it or not. Yeah, boring, old, stupid whole life policies, specially designed whole life policies with the exception of the 2 New York Life ones. And I'll show them to you in just a second. But I take a loan from my policy. I put it into the company, okay, that hired Stefan, that paid for all the tech. It paid for all the legal, which was absurd how much legal it was to open the RA. It paid for all that stuff. And now that loan that I made to that company, to that incubator company, I didn't pay myself back from that loan yet. And that's the beauty. I'm in control of it. I took a loan from my policies. I used it to start this company that I know in the future will be worth significant money. Okay. But I don't know when that company is going to become profitable. We have projections and everything. So let's just say in 12 months from now, it'll be profitable. In 12 months from now, when it's profitable, okay, at that point, that company will then begin to pay me back, but not just the principal. It will begin to pay me back on a monthly basis, principal plus whatever deferred interest is there. And that company will continue to pay my private banking system until the loan and all the interest is paid back. What is the return for me on that? Well, some would say, well, the return is whatever I charged in interest, 6.5% over the period of time that company used it. But isn't my return also what that company makes me in the future? Isn't my return also what I could sell that company for in the future? Because I'm building a company. I'm building a company that will have tangible value in the future and an exit. But that company will also be cash flow positive. And I'm also providing jobs to people. I'm providing opportunities to people. So like when you think of business opportunities, I don't think there's a single greater place that you could put capital. Buying SpaceX or Apple or any stock, those are all great. But you are your best investment, and your dreams and goals should be the first thing you invest in. And if you need knowledge, invest in knowledge that then gets you to your dreams and goals. That's business opportunities. Real estate. I've had tons of experience with real estate, not all of it good. Okay. COVID knocked me like a Mike Tyson left hook is what COVID did. And I got burned out. But could you use money for your policies to fund real estate? Is real estate a good investment? Yeah. Made more millionaires than any other single investment out there, period. So you could invest in real estate. But the other thing, during all these investment opportunities, from cars to business opportunities to real estate to whatever you want to call it, stock investing, mutual fund investing, options investing, whatever you need money, seed money to invest in, imagine that during that entire time, you always have an emergency fund. And during that entire time that you're doing all these investments, your money, your initial base amount of money never stopped earning for you. And imagine during all that, it never stopped earning for you in a tax-free environment, or a tax-efficient environment, as I like to call it. And imagine during that entire time, no matter who sues you for whatever they sue you for, they can't touch that money in most states. Like, you see how this is starting to make sense? You're covering all the bases, and all you did is change where your money went first. And you still have term insurance, and you're still investing the difference because you're probably putting money in retirement accounts for tax savings. You're probably putting money in brokerage accounts. You see, I do all this. I can't say I buy term invest the difference, but I really do. I mean, ask anybody that's around me. I have term insurance, and I still put money in a Charles Schwab account every single week. I put money in a crypto account every single week. So I am investing the difference. But I am also way ahead anyone that just relies solely on buy term invest the difference, because I've also got my private banking system, a bunch of whole life policies. They have a bunch of death benefit that will make sure my family is taken care of in multiple generations after I'm gone, because that money will pay out no matter how old I am, no matter how much time goes by. And during that entire period of time, I used the cash value. for all these things I'm just mentioning, and there's only a few of them. How about college and family? You don't think I have policies on my daughter? Darn right I do. I have 2 on my daughter, 3 on my wife, and another one coming on my wife soon. What are those going to be used for? Family, funding of college, if Vivi wants to go to college or trade school, or maybe just vacations, whatever I want to use it for. And all of this is wrapped around a nice little tax strategy. And that tax strategy for me is different than yours. But mine is all the money that builds inside my policies is growing tax-free. How much money is that? Well, I don't want to brag or anything, but last year when we did our increase of my line of credit, my policies, all my policies, grew by more than $100,000 in guaranteed growth. Over $100,000 in growth. I didn't have to work any harder for that. My family didn't have to suffer anything. My family didn't have to be at risk for anything. That was just the internal growth of the policies. It's not bragging, folks. This is your reality just the same as it is mine. You just got to take that leap and that step. So my tax strategy then, when those death benefits are paid out, they don't pay to my family directly. They go into a trust. That trust has a set of instructions. That set of instructions makes sure that my family can maintain that legacy for multiple generations. So that I end up like the Vanderbilts, where 3rd generation squanders what today would have been probably hundreds of billions of dollars. Gone. Because 3 generations after the Vanderbilts built their wealth, it was all gone because somebody didn't know how to manage money, and it wasn't controlled with a set of instructions. You see, these are just the strategies. These are those systems you have to build, which is why I want to take this right now and I want to bring it into the one shift that changes everything. Because it is just one shift. First, it's a mental shift, and then it's a physical shift. Here you go. The old system is you save, you spend, you repeat. The new system, quite simply, and write this down, take a picture of this. You save, you control, you use, you replace, you repeat. Your money continuously and forever stays in motion. Your money's continuously 24 hours a day, 7 days a week, earning for you. No matter what your money is used for, you never stop the compounding effect, ever. And Albert Einstein, love it or not, said that the compounding interest was the 8th wonder of the world, the most powerful thing in the world, or the financial world, I think is what he meant. So how simple is that? All we did here through this whole thing is we said, change one thing, where your savings goes first. That's this, the new system. You just changed where your savings went, okay? Then you learned how to control your money, how to build a private banking system. You learn then how to use your money through the infinite banking concepts, which we have software called the Vault that will run all that. And then you just replace the money as you used it, because instead of paying the banks and the finance companies, you just paid yourself the same amount of money you were paying them. Your cash flow never changed. You still have term insurance to cover those things that are of a term of time, okay? You're still investing other monies in your 401k. You'd be remiss, folks, if you think that our clients, our 7,000 plus clients, are all only putting their money in whole life. You'd be kidding yourself. Hell no, they have term. Heck yeah, they have advisors. They're investing money. They're working with PMC Wealth. They're doing all these different things. They're putting money in annuities. They're not just one-trick ponies. Not at all. Neither should you be. But let's now go to what I think is my favorite thing. Then I want to show you some numbers. What the wealthy families build. Wealthy families invest money, but they don't just invest to invest. They invest into systems. And this is critical. Wealthy families build systems. The money always continues working for them. That's why wealthy families are different than rich families. Rich families look rich, have nice things, but when you peel the curtain a little bit, they're one emergency away from being the next broke person. Wealthy families have figured out how not to give the money back, okay? And how they've done that is through systems. Systems that allows their money to stay working for them. Systems that make sure that their money stays available and in their control. Systems that keeps their money working for them in their control in a tax-efficient manner. And most importantly, that money is all designed to feed the next generation and the next generation. You see, these families don't work in terms of what will I return. They work in terms of what problem is my money solving? What problem is my money solving? That's all money is. Money's a tool to solve a problem. What problem do you want it to solve? Well, wealthy people have different problems than the rest of us, okay? But we all have money problems, and we all need money to solve those money problems. So if your money's working for you in a controlled environment, earning uninterrupted compounding interest while still providing protection and investments, you have created a system that will serve you well, because the legacy is not the amount of money, okay, that is passed on. The legacy that you create is what you architect it to be. So for me, one of my biggest legacies is a book I'm writing right now. It's called The Key to It, The Key to It All. Okay. The Key to It All is basically my life story written in third person about a father and a daughter. And in there, it literally spells out the secrets that I've learned this far in my life. And all of you will have opportunities to get a copy of this book. It's not out yet, and I'm not in a rush, but that's my legacy. But that legacy, on top of the policies, on top of the trust, on top of all the stuff that I'm building, it was all architected. What are you architecting? What are you designing? So with that being said, Craig, is there anything you want to add to any of that or any questions that came through? And book a call with us, folks. Give us your number. We'll reach out. We'll set up a call with you and kind of go through everything that we're talking about here. But again, I want to pose some questions to you before I show you the vault, and I want to show you just some of the numbers, because a lot of you are like, oh, what do these specially designed whole lives look like? I'll show you mine, okay? And I've never shown this before, because I sometimes I feel like I'm probably showing you things I shouldn't be showing you, but whatever. Here, I want you to ask yourself, what job is your money supposed to do? I want you to ask that question. Write it down. You don't need to answer it right now, but what job is your money supposed to do? And how much control do you need over your money to do that? Okay, that's the question I want to ask you, and it's the only question. That shift alone, when you think about money, will change everything. It will change everything in how you view money, how you use money, and how money goes to work for you. Again, I'll repeat it again in case you didn't get it. We can type it into the chat, someone. What job is my money supposed to be doing? And how much control do I have over it? That's it. That's what I want you to ask. Now I'm going to share my screen. I'm just going to show you the Vault. The Vault software is a software, proprietary software that we designed. Craig was the architect of this, and it's pretty freaking amazing. It's all I can say. One of the big things that I had problems with in my life is I have lots of policies, and they're not even all in here, but I have lots of policies, 14 in total. We're waiting for a couple illustrations to come in. And this aggregates all my policies. So you can see I got 7 of the policies in. That's the amount of my premiums on those 7. Premium capacity, and 100% is being used. So once I go into here, what I can do is I can come down here to my policy officer. I can select a policy. So let's just pick on, which one do I want to do? That's Vivi's, mine. I'm trying to look at the dates. Maybe this one. And it will give me my specs. Okay, so this is just an overview. So this shows, here's my death benefit, my cash value. Some of you might be looking at the death benefit like, well, what happened there? Well, in my illustration, what happened is the term falls off because we have a term rider on this policy. But let's just come down here and look at this. This is a policy detail summary. Okay, so from here, you can see this is a policy I started when I was 45. I'm soon to be 49. I did a dump into the policy, but each year, here's my premium, $15,000 a year into this one. So I put in the first year $89,322. And actually here, I'm going to do this a little different because I want to be able to show you guys a couple of things. So this is my premium I put in the first year. In the first year within this policy, this is how much I had to use. Okay, I put in 89 and I had 83 to use. That's not too bad. That means in the first year, with cost of insurance, my cumulative rate of return was negative 6.3. So negative 6.3. Let's just figure this out. I want to do a comparison to you here really quick. So if we take 89,322, which is the amount that I put in, and we multiply that times 0.063%. That's $5,627, give or take, okay, that I basically gave up in that first year to provide a death benefit of, I hate that, 667. We're just going to round up, okay? So that's what it cost me my first year. Now, a lot of people would be like, that's awful. That's terrible. Okay. The next year, I put in 15,000. So now I got 104 in the policy. My cash value is 100,000. My cash on cash return this year is 12.4, but still total overall, I am down 3.6%. So hold on. 2 years into this program, let's do the math. 104. I think I'm doing this right. Craig, you're better at math.
And Chris, it's right there in that net cash value growth column, just to the right. So you'll see the 18.
Oh my gosh. There we go. So there we go. Thank you, Craig. So now it cost me, if I'm doing this right, I think it cost me $1,859 to provide $694,000 of death benefit. Is that right, Craig?
Well, that is the cash value growth. So are you trying to figure out what the negative is?
Yeah, I was trying to figure out, like, yeah.
Oh, yeah.
Sorry,
Yeah,
I think I know what I was doing. 104, 322 times 3.6%.
Yep.
All right. So this year, in the second year, it cost me $3,755.59 to protect my family, $694,000. Plus I had access to 100,000 of the 104. Everybody tracking with me? I'm getting through the bad stuff first, okay? Now, third year, I do the same thing. I put 15 in. I have 119,000 in the policy, okay? I have $117,000 to use. So now how much did it cost me? $2,323, give or take, okay? Or 1.2%. So now let's do 1.2% of the total amount that I've got in. I'm doing cumulative. Now, I would never figure this out like this for infinite banking, but I'm just trying to show you, and I'm trying to do this in comparison with term. So now it cost me $1,431, okay? $1,431. I could not, in my wildest imagination, buy a 30-year term policy for $1,431. And now I have 722,000. Notice how my death benefit's going up. I know Dave Ramsey has you all believing that your death benefit doesn't go up. And if you die, the insurance company keeps all your cash value, to which he's actually kind of right. But the cash value increases the death benefit. Okay, let me repeat that. Your cash value growth increases your death benefit. You are seeing it real time. But here's the beauty. 3 years in, and in 3 years, cumulatively, I have lost 1.2% or $1,431. That's how much money I have lost. Okay. Now, the next year, I do the same thing. I put 15 in. I've got 134 in there. But now my cash value is 136,000. This took 4 years. I've gotten all my money back. Unless anyone's doing the math differently here that's watching, you're seeing my numbers, and I can do every one of my policies the same way. Have I not gotten every penny of every dollar that I put into this policy back right here? Okay. Is there ever going to be a day in the future? This is not an indexed universal life. There will never be a day in the future that I have less money than I do now. It will always go up. As you can see, every year it goes up. No ifs, no ands, no buts about it. So at this present point in time, I have made 1.3%. Now that is nothing to write home about. But if you did term insurance, you would have just paid for the insurance. I got all my money back. Now someone would say, yeah, but I invested the difference and that made money. Granted, got it. But now let's take that. Yeah, but I invested the money and I made a return on that. Could I have not taken in the first year, within the first 30 days, $80,000 out of my policy and invested in the S&P 500? And then if the S&P made the magic 12% Dave Ramsey says it always makes, or some magic mutual fund, would I have not made more money than you did? I would have. And every year, what if I did that? The next year, I took the difference out. I took an additional 20 grand out, okay? And I invested in Dave's magic mutual fund. And the next year, I took the money out and I invested. And the next year, I invested. Who's winning the race now? You see, I'm making money twice. They're making money once. I'm not saying there's anything wrong with the buy term invested difference. I'm simply trying to show you the mathematics. Like it's a rigged game. The buy term invested difference person cannot beat me. They can't. And they won't. Because I'm making money twice. And every year I make more. The next year I'm at 3.9. And I'm just looking at cumulative here, folks. If I do cash on cash, which is my return on my money that I put in, my new dollars, look at that. But let's just look cumulative. Okay. By the sixth year, I made 6.5. Then I made 9.3. Then I made 12.2. Then I made 15. Then I made 18. Then I made 22 on top of whatever my investment makes, on top of whatever PMC Wealth makes, on top of whatever I pay myself back for buying the cars that I want to drive, okay? On top of investing money in crypto, in Charles Schwab, and anywhere else. On top, remember, this is that, it's this and that, okay? This is the and asset, as Caleb talks about in his book, The And Asset. It's this and that and that and that and that and that. I just wanted to show this because, like, you can't deny this. This is my policy. This is, oh, and some people are like, oh, that's manipulated. You know, I guarantee you there's someone on here, then maybe they wouldn't say anything. There's no way that's not what it looks like. Okay, well, here, hold on one second. You know where these numbers right here came from? Let me show you. Right here. My illustration from the insurance company. Oh, wow. Exact same numbers, all populated right here. And you know, the beauty is right here, this has got my policy number. It's got everything on there. It shows everything. So you know I'm not making these numbers up. I'm not cooking the books. There they are. There's the numbers, which are exactly the same as the numbers we just looked at. And then I can even go one step further and I can come down and I can start looking at every single thing I want to do with this. I can go to the loan officer. I could say, okay, and here, I'll actually do one for you right now. Let's see, loan details. I'm going to be buying a car. Let's just call it 252,000. Let's call the interest rate 6.7%. Interest payment. So this is, the interest I'm going to be charged by the insurance company. I'm just going to add it back onto the balance. I'm going to do a monthly payment, number of payments. I'm going to do 60. Let's do 72 because it doesn't really matter. 72 payments. Okay, let's see. Select a policy. Which one do I have enough in? I got to use a couple of them. So I got to use a couple of policies here. All right, so let's do that. Now we're going to come over here, personal loan planning. All right, borrower details. I'll be the borrower. Buy it purposely. I'm just going to buy a dumb car. 6.7, 72 months. My payment will be that. So now
You need to
let's
put
just,
your last name in as well, or just put something in there.
thank you. All right, but here, let's just say I'm like, ouch, I can't afford 4260. Can I not put 90 months in? I can dial this sucker to be anywhere I want. I could finance this sucker for 120 months if I wanted. I'm the bank. I make the rules, but I'm just going to go 72 months. All right, let's see. There we go. So now I can do several things. I could say, all right, I want to generate the promissory note, okay, because that's going to be necessary. The system will generate that. I can execute the loan, and I can do the loan right here. But the big thing I want to show you down here is this is effectively, am I doing this right, Craig? Let's see.
Yeah, just go back to the policy loan planning and pick one or two.
Pick the policies. Yeah, I knew I had to do that for some reason. Where do I pick them from?
Should just be able to.
It's not letting me pick them. Download the loan form.
Scroll down.
Select policies.
Scroll down. Yeah.
Did I do it?
Yeah, just you need to scroll down.
Oh, there we go. There we go. All right. So I don't want to do that one. Yeah, we'll do that one and that one. There we go. So it just selected the first couple. All right. So now let's take a look at this. Here's my whole thing. It's not going to take me 72 months to pay this thing off. It's going to take me 62. I'm going to pay $286,372 for this stupid car. The interest I'm going to pay is $34,000. The base rate, 5.43, because it already factored in how much my policy's loan interest rate is, and the effective APR. So how much did I actually pay in interest to the insurance company? Can anyone guess? Is it 5.43 or is it 2.64? It's 2.64. Okay. Premium, cash value gained, death benefit gained, right down here. Total financing, 252, interest paid, total amount lost forever, 295. But then how much money did I get back?
And Chris, yeah, I think that's a key. You want to make sure everyone
I was skipping that. I wanted to kind of make them think I lost 292. But this is how much money I got back.
Yeah.
I got back $119,932 just in cash value growth. Okay. Remember, I used all that cash value from those policies, but those policies still earned for me. They still made me $119,000. And remember, who was I paying back that entire time on that loan? I was paying myself back. So did I not get all the money back for the car plus make money on it? I did. You see, this is the only way I've ever found where I can make money buying stupid cars. Like cars almost all depreciate. Maybe this one won't because it's a collector car, but nonetheless, like almost every car you're ever going to buy is going to depreciate. I just gave you a really loaded example here on something I'm doing where it should have absolutely positively been a loss, but it wasn't. I got all the money back.
And Franklin asked a question, but I think you just answered it. Franklin was asking about what that illustration you were showing, Chris. What really happens to those numbers if you take a loan? And we just proved nothing.
Yeah, nothing.
It continues to grow, and that's now there are some insurance companies out there where that may not be the case, but
here's another one.
Yeah, in this case where you see that cash value growth column, taking a loan is not going to impact that growth number at all.
Yeah, these are what are called non-direct recognition companies. The only company that wouldn't in my policies, the only company that would not would be Vivi's Guardian policy. Okay, because that's a direct recognition. So when we took a loan from Vivi's policy, if we did, it would affect her growth. But you see the thing I'm not going to get into the details on. All of these policies make up a cash value line of credit. So it doesn't matter that it's direct or non-direct. But just in general sense, like this policy through Mass, this particular policy is a non-direct. So if I took all this 20 grand out, I still earn the same amount. So if we look at the cash on cash return, 3.1, 9.7, 14.1. If I took all 113,000 out, I still made 3.1. I still made 9.7 that year. It doesn't affect it at all. I just got the loan interest, but the loan interest is offset by what I'm using the money for. That's what a lot of people miss as well. So I just wanted to kind of show you all this and give you a real example of the loan officer at work. Now, I didn't save that one, but it just kind of shows you that we are not sitting here trying to debunk or say that buy term invest the difference doesn't work. But it just isn't the best strategy for everyone. And it isn't the best strategy as a standalone. I already do it. I do buy term invest the difference. I don't call it that, but that's what I'm doing. But in addition to that, I built my own private banking system. So has Craig, so has Steven, so has Brian, and so have a whole bunch of you on this webinar. And that's just what we're recommending. So Craig said, I can't resist. How are you paying yourself back when you are not borrowing your own money? I don't know if I understand that. Do you, Craig?
I think it's kind of a semantics thing to some degree, but I think what Craig is saying, you're not borrowing your own money because you're borrowing the insurance company's money. That when you take a loan, the loan is coming from the general fund of the insurance company. Now they're using your death benefit as that collateral. So if you never pay that loan back, they're going to take it right off your death benefit. But think of the cash value, it's a ledger amount, is the way I almost look at it, is although taking a loan doesn't impact the growth, what they do is if you had $100,000 available cash, you take out 50, well, now you have 50 available. When you pay back that 50, you're paying that back into your system, so you now have 100 available. So I think what Chris is sharing is we use the insurance company's money while ours continue to grow. They do a ledger account on our cash value availability, and then we put it back. So some semantics there, but hopefully that helps clear that piece up a little bit. Yeah, and Shonda says it's like a credit card. You pay the balance and swipe it again, pay it back, swipe it again. So
Yeah, it would be like, that's a good analogy. It'd be
yeah.
like a credit card, but you pay your credit card back before they ever charge you any interest on it every month. But then let's just say the credit card was using your own money, so more like a debit card, and you're earning on all that money. I guess I saw that differently, but anyway, similar, but you're not losing any control of your money because every time I'm making those car payments back on that car, I know it seems like a big payment, but really, if I have the cash flow to be able to make that payment, it to me is not a payment. Okay. If I finance that through Porsche, that would be a payment. I would hate making a $4,200 payment every month. It would drive me absolutely bonkers. But making a $4,200 recapture deposit back into my account, that's just me saving money. That is literally all I'm doing. $4,200 is going back into my policy that I could use the next day. I lose no liquidity of it. I lose no control. That is not a payment. By no account is that a payment. I can call it whatever I want in my mind because I'm the bank and I'm buying the car and I'm repaying my bank, but it's my bank. It'd be like you own a bank and you make payments to your bank, but it's your bank. You keep the money. It's your company. So it is a mindset shift. It really is. And I think that's one of the biggest hurdles we deal with when we teach the infinite banking concept is that mindset shift. And it's the same thing when we talk about retirement distribution strategies and guarantees like we did with Brian. It's a mindset shift because a lot of people don't believe this is real. They don't believe this actually can happen, but we just showed it to you. It isn't that it can happen. It's that it's happening every single day and has been happening every single day for hundreds of years. Started by the Morgans, the Stanleys, the Rockefellers, the Rothschilds, Morgans, not Warren Buffett, but Doris Christopher, Walt Disney, Ray Kroc, McCain before he passed. They all used this, and they all used it for something different. Starting the Ronald McDonald marketing campaign and funding his staff was McDonald's. Walt Disney used it to start Disneyland. Shauna loves Disneyland. McCain used it to fund his political campaigns. Biden, love or hate him, like he I guess had a whole bunch of mass mutual policies as well, and I'm sure he did the same thing. So everybody uses it for something different, but it doesn't matter. They're all in control of their money. And I think every one of those families that I just mentioned, I think you all know they're very wealthy families and they will maintain wealth. So really the call is yours. I just thought it was super important that we did this, that we explained buy term invest the difference. But with that being said, folks, we are wrapped, and I know we're way over. I think it's awesome. Remember, each week we do this, the same great time, the same great place. So invite some friends, tell some people, bring your IUL friends, bring your Primerica buy term invest the difference friends. Let's make this a party and let's all educate and learn how to be smarter when it comes to money and learn the truth about how money really works. With that being said, we'll see you on the next one.